All right, the market is coiled for a major move. The AI rally has been relentless, but it's about to slam into a wall of event risk this week. We're going to break down the framework for the next 1 to 2 weeks so you can position accordingly.
So here's the core tension. The market is clearly in melt-up mode, right? But this week, that powerful AI-driven rally runs directly into a wall of make-or-break catalysts. Let's be clear, the easy part of this trade is over.
Look, it really boils down to this: the Fed's decision and mega cap earnings. These two events are going to dictate the market's direction for the rest of the quarter. Everything else is basically noise until we get clarity here. A major move is coming, one way or another. Okay, let's get into the primary catalysts. This is what you need to be watching. First up, the Fed. The CME FedWatch tool is showing a 99.9% probability of a 25 basis point cut tomorrow. So the cut itself is a done deal. It's completely priced in. It is a non-event. So if the cut doesn't matter, what does? It's all about the forward guidance. It's about the language Powell uses. Is it a dovish cut, where they hint at more cuts to come? Or is it a hawkish cut, where they cut but signal they're going to pause for a while? The market's entire reaction will hinge on that commentary. The language is everything.
All right, catalyst number 2, mega cap earnings. You know the names: Microsoft, Google, Meta, Amazon, Apple. Let's be honest, the entire AI narrative has pushed this market to all-time highs. Now it's time for these giants to deliver the numbers. This is the ultimate test. Will their earnings validate the hype, or will they expose a rally that's gotten way ahead of itself? And look how packed this week is. It's just dense with catalysts. Tuesday, we get Palantir earnings, a key tell for AI spending. Wednesday at 2 p.m. Eastern, the FOMC decision hits. Then Thursday, a US-China meeting. And then, bam, Thursday and Friday, the rest of the big tech earnings drop. We are looking at a 72-hour window of potentially extreme volatility. Okay, so beyond the Fed and earnings, we have to talk about the wild cards. These are the risks simmering in the background that could easily override everything else.
You've got 3 main ones to track. First, the US-China meeting on October 30th. Frankly, skepticism is high for any real breakthrough there. Second, the government shutdown. It's been dragging on for almost a month, and a resolution would be a major positive shock to the system. And finally, you always have to watch for any escalation in the Russia/Ukraine conflict, which can instantly spike energy and defense sectors. These are the kinds of things that can cause a big gap move overnight. So with all that in mind, let's drill down into the sectors that are really in play right now: AI and energy. You know, there's a really interesting divergence happening within the AI trade itself. Money is flowing out of what you might call the speculative vaporware, the pre-revenue story stocks, and it's moving into the fundamental picks and shovels plays. We're talking about companies with actual tangible revenue from supplying the AI ecosystem. This is a key rotation to watch. And a perfect example of one of these picks and shovels plays is Micron. They're at the center of the AI memory thesis, benefiting directly from the absolutely exploding demand for a critical component. And that component is high bandwidth memory, or HBM. It's essential for training large AI models. The key number here is 34x. That's the cited increase in demand for HBM. This isn't just a small bump, it's a fundamental demand shock. And it's driving massive margin expansion for a company like Micron. But the picks and shovels trade goes way beyond just chips. Think about the data. Reddit is monetizing its massive data set through licensing deals with AI companies. Then think about the power needed. NextEra just landed a 25-year nuclear power contract to fuel Google's data centers. And that in turn creates a strategic play on raw materials, like uranium, which benefits the sole US-based producer, Energy Fuels. It's all connected. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice. Okay, with that out of the way, let's get to the game plan. We're going to lay out the scenarios and the key levels you need to watch. My base case is that we get a mixed signal. The Fed delivers that dovish cut, but the big tech earnings are just okay. Not great, not terrible. The outcome? The market chops around, stays range-bound. The key level to watch is SPY 690. If we can't hold above that, the posture is neutral. Sit on your hands, maintain cash, and just wait for a clearer signal. Now, the bull case is simple. You need both drivers to hit: a dovish Fed plus strong tech earnings across the board.
If that happens, the AI rally gets validated, and the melt-up probably continues. The trigger is a clean break and hold above SPY 690. If you see that, the posture shifts to increasing long delta exposure.
And the bear case? A disappointment from either side. A hawkish cut from the Fed, or a key tech name misses and guides down. That could trigger a sharp reversal. Your key triggers here are SPY breaking below support at 685, and, just as important, watch NVIDIA. If NVIDIA fails to hold 200, that's a major red flag for the whole AI thesis. In that scenario, you reduce delta and add hedges.
All right, let's talk about some potential trade structures to play these scenarios.
Okay, first up, a bullish structure on the picks and shovels theme. The ticker is Micron, based on that HBM demand thesis. A call debit spread with a 1 to 3 month time horizon could make sense here. You're playing the strong fundamental momentum, and your risk is clearly defined. Your max loss is just the net debit you paid for the spread.
And on the flip side, what about a hedge? To protect against a negative surprise from the Fed or those US-China talks, you could look at a put debit spread on the SPY. This is a short-term structure, maybe 1 to 2 weeks out. You're exploiting the elevated event risk, and again, your max loss is defined. It's a clean way to add some downside protection.
So that's the setup, and it really leaves us with one critical question. Is this market melt-up actually justified by fundamentals, or is it just running on fumes right into a wall of risk? Not trading advice, just a market update to keep you informed. Markets carry risk. Trade your plan, manage downside, and verify all data.